The new senior deduction can mean big tax savings, but you got to qualify. You've got to qualify. What are those rules? And then what are the strategies to ensure that if you're close, you make sure that you maximize it and qualify? I've got that and more coming up. Part of the new OBBBA tax rules is the senior deduction, and this can mean meaningful savings, thousands of dollars of tax savings for those of you that qualify, but you've got to qualify. Well, what are those qualifications? A lot of people, this was originally told to us as no tax on Social Security. That's not what they were able to pass. Being on Social Security isn't even a requirement, okay? What are the qualifications? What are the requirements to receive this new senior deduction? You've got to be age 65 or older. Well, there's no planning strategy. I can't help with that. So you either are or you aren't. But if you are, then the other qualification is your modified adjusted gross income needs to be below certain limits. If it's below those limits, you get the benefit. If it's above those limits, then some of the benefit starts being reduced. And if it's too far above, if your income's too far above these limits, then you don't get any of the benefit at all. What are those limits? Married filing jointly, your modified adjusted gross income needs to be below $150,000. Single filers, half that, $75,000. So this is a decent amount of money, but when you're in retirement and you've got a lot of moving pieces with your income, it's very possible, even just not being aware, you could slip above these thresholds. If you go above these thresholds, you don't lose the entire benefit, the new deduction. You just start getting less and less of it. If your income's too high, I know for married filing jointly, if your income, modified adjusted gross income, gets all the way to $250,000, you lose this deduction completely. But like I said, this deduction is meaningful. It's $6,000 per person. So married filing jointly, if you're both 65 and your income is below these thresholds, $6,000 per person, $12,000 in a deduction. One of the common questions with this new tax law, the senior deduction, is, well, do you get it even if you itemize your taxes? Well, if you add up all your itemized deductions and it's higher than the standard deduction, yeah, you're going to take the standard deduction, but you can still get this senior deduction. So in that case, still lucrative, still something that you need to be planning for and being aware of. If you take the standard deduction though, let's just do that math. Married filing jointly, standard deduction this year, $31,500. But if you're age 65 or older, there's an existing extra standard deduction that you get of $1,600 per person, plus this $6,000 per person senior deduction. That means those of you standard deduction, age 65 or older, that can qualify for this new senior deduction, your total deduction, over $46,000 of income just erased and not taxed at the federal level. Single filers, a little bit more than half that, almost $24,000 of income just erased. So again, you want to qualify. You want to maximize this new benefit. How do you do so? What are some of the strategies that if you're close to this threshold, or maybe you're a little bit above the threshold and you're getting phased out, what are some of the strategies to bring your modified adjusted gross income down a little bit so that you can either maximize and qualify for the full benefit or qualify for as much as possible? First, be careful with Roth conversions. That's right, be careful with Roth conversions. We love Roth conversions when you're in low tax brackets. We love Roth conversions when you're early in retirement. We love Roth conversions around 65 or 63 or 64, right? So this is a sweet spot for those of you early in retirement or maybe not quite retired to do a lot of Roth conversions. And if that's you, this doesn't mean no longer do Roth conversions. You just need to be more careful about how much it might influence how much Roth conversion you do. Real quickly, the Roth conversion strategy, this is where you take previously pre-tax dollars that you contributed either pre-tax to your 401k to the traditional IRA, maybe they were company match dollars, it's never been taxed. You convert those, you transfer those, you move those from that pre-tax IRA to the Roth IRA. That maneuver is taxable, okay? So it lands that however much you do, whether it's $15,000, $20,000, $50,000, it lands as taxable income in the year that you do that conversion. But the reason why you would do that is now you've got those dollars in the Roth side of the ledger so that they grow tax deferred and tax free for your future. Again, you want to do this when you're young, you want to do this during low tax years, and a lot of times that's early on in retirement. Doing this may make sense now, even with this new senior deduction, but you're going to want to do so with being very careful of how much Roth conversion should you do, because what is your modified adjusted gross income going to be? If you are already at around $120,000 of modified adjusted gross income before doing a Roth conversion, you might want to do a Roth conversion of 25 grand or 30 grand, something that maybe gets you close to that threshold, but not above. A lot of times early in retirement, people are doing Roth conversions, getting themselves up to into the 22% tax bracket, but below the threshold where it would trigger IRMA, the income related monthly adjustment amount surcharge for Medicare Part B and Part D. If you do that, you're now going to limit yourself. You're going to be in the phase out of this new senior deduction. You might want to scale that back some, work with your certified financial planner on that. Second strategy to make sure you maximize this new senior deduction is avoid unnecessary capital gains, unnecessary generating of capital gains. This is also something that is very common to do early in retirement because you need liquid resources. You've had some investments maybe that are in an individual account or a joint account, trust account, maybe dollars you inherited. You've received them and you're ready to live off of them. You need them liquid because you've retired and you need to supplement your Social Security. It's very common early on. It's also very common to do this in low tax brackets. When you're in the 10 or 12% federal tax bracket and you generate some capital gains, those dollars are taxed at the 0% federal capital gains rate. If you're just over that and you're into the 22% tax bracket, then those dollars would be taxed at the 15% capital gains rate. But still, this is a common thing to do early in retirement, around 65. Well, if you generate capital gains unnecessarily and all of a sudden that pushes you above this new threshold for this senior deduction, then that capital gain would have really actually cost you more tax because you're losing some of this benefit. Plan ahead and be aware of where you stand and how much capital gains you should generate or maybe will want to avoid, and be ultra careful with generating any unnecessary income. And then a third strategy you may want to employ to ensure that you maximize the new senior deduction is you may want to withdraw dollars from other resources. What do I mean by that? Consider you're retired, you're on Social Security, you've got a pension, and to supplement those sources of income, you're drawing, say, $3,000 a month out of your IRA. So something like that. Something like clockwork automatically replicates a paycheck that you don't really need to think about. It all comes in and you're spending dollars, and you need that income coming in order to live the lifestyle that you want. Well, here we are into the fall, almost the fall of this year. And if you look and you say, you know what, if we continue, if you're doing your tax planning with your CFP, if we continue to just draw this $3,000 a month automatically like clockwork for the rest of the year, it's going to push us beyond this $150,000 or $75,000 single threshold for modified adjusted gross income. It's going to limit our senior deduction. Are there other resources that you could be drawing from to still receive that cash flow, but in a manner that it's not taxable? It's not going to land on your tax return. Is this a time where maybe you would dip a little bit into that Roth IRA? Do you have savings that you could draw from, a joint account, individual account that you could draw from, even though automatically you've said, yeah, we're into the 22% tax bracket. It's not that big a deal. We're going to be drawing dollars like clockwork out of our IRA. If it's going to push you beyond this limit, maybe the last 2 or 3 months of the year, you stop those withdrawals from your IRA and start them from your Roth, start them from another account, or just draw down some of your savings to ensure that you maximize this new tax benefit. So those are 3 strategies to help you maximize the senior deduction. I'm going to throw one other in there. If you're working part-time, but you're age 65 or older, but by working part-time, you've got earned income, and you may be able to contribute pre-tax to a traditional IRA to reduce your modified adjusted gross income, allowing you to qualify for more of this new senior deduction. All of those are just ideas though. Tax planning ideas, whether they make sense for you or not, need to be considered in the context of all 6 areas of your financial life by working with your CFP. So work with your CFP on that. If you don't have a CFP in your team, you can contact one on our team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.